Taking a look at the market this morning, Strive Inc., ticker symbol ASST, is active right out of the gate. The stock is currently trading at 117, which is a move of about 2.18% to the upside since the opening bell. This follows a previous close of 115, where the stock finished flat. What's immediately striking, and what many staring at this 117 price tag might miss, is that this isn't just a low-priced stock drifting on market currents. The relative calm of this morning's open conceals the sheer financial aggression this company just executed. Just 4 days ago, Strive closed a massively oversubscribed preferred stock offering, pulling in $160 million. This wasn't a move of desperation. It was a move of calculated amplification, and it fundamentally changes the entire thesis for this company, for better or for worse. The general expectation for ASST, especially when you look at its 52-week range swinging from 34 cents to over $13, is that it's a volatile, speculative, low-float play. It's seen by many as a simple proxy for Bitcoin, a sort of junior league microstrategy. The narrative on forums and social media is one of high-octane potential, a 10x candidate if Bitcoin catches its next major tailwind. That's the expectation. Buy a cheap stock, hope the crypto market lifts it, and ignore the fundamentals. But the reality is infinitely more complex and frankly far more interesting. The reality is that Strive is running two distinct businesses under one roof, a traditional asset management firm and a high-leverage corporate Bitcoin treasury. And it just tied a $160 million anchor to its balance sheet. Understanding this dual-engine, high-risk model is the only way to make sense of its trajectory. Let's first look at that recent activity, because it's the key. The stock has been all over the map, down over 80% in the last 6 months, but still up over 100% year-to-date. This isn't trading, it's whiplash. The major catalyst and the source of all this new pressure was the November 10th announcement. Strive closed an initial public offering of a new class of stock, a preferred stock trading under the ticker SATA. They initially aimed to sell 1.25 million shares but saw such strong demand, they upsized it to 2 million shares, priced at $80 per share. This new preferred stock comes with a 12% annual dividend. The entire purpose of this $160 million raise was to immediately go out and buy more Bitcoin, and they did. The company announced it had acquired 1,567 Bitcoin at an average price of $103,315. This brings their total corporate treasury to 7,525 Bitcoin. This is the crux of the bull-bear debate. The company is using non-dilutive financing, at least not dilutive to the ASST common stock, to acquire a volatile asset, all while promising to pay a hefty 12% dividend to the holders of that new preferred stock. This is where the business model becomes so critical. Strive Inc. isn't just a shell company holding crypto. Following its September 2025 merger with Asset Entities, it positioned itself as the first publicly traded asset management Bitcoin treasury corporation. That first part is key. Strive Asset Management LLC, its subsidiary, is an SEC-registered investment advisor with over $2 billion in assets under management, primarily across a suite of ETFs. This is the real business, the part that generates fees from managing other people's assets. The second part is the Bitcoin treasury, which acts more like a corporate-level leveraged bet. The strategy is to use the stability and fee generation of the asset manager to help finance and support the aggressive accumulation of Bitcoin on its own balance sheet, with the stated goal of increasing its Bitcoin per share and outperforming Bitcoin itself over the long run. Now let's bring in the other side of the trade, the short sellers. This is where the tension becomes palpable. The expectation from many retail traders is that this stock is a prime candidate for a short squeeze. After all, it's heavily hyped in forums and has a low share price. But the reality of the data tells a much more precarious story. According to recent data from Fintel, the short interest in ASST is extremely high, standing at 18.40% of the float. This means a significant number of institutional players are betting heavily that the stock price will fall. Their thesis is not hard to understand. They are looking at a company with deeply negative operating margins and negative cash flow that just willingly took on a new massive liability. Strive now has to service the 12% dividend on that $160 million in SATA preferred stock. That's an annual obligation of $19.2 million. The short sellers are betting that the fee-generating asset management business, which is already operating at a loss, cannot possibly cover its own costs, plus this new $19.2 million dividend payment. They are betting that if the price of Bitcoin stagnates or falls, Strive will be forced to sell its precious Bitcoin treasury just to pay the dividends on its preferred stock, creating a death spiral for the common stock. However, there's a crucial countersignal that every investor must be aware of. While the 18.4% short interest is high, the days to cover is exceptionally low, just 0.41 days. This is a measure of how long it would take all short sellers to buy back their shares, based on the average daily trading volume. Because ASST's volume is so astronomically high, recently hitting over 100 million shares in a day, against a 67 million share average, shorts are not trapped. A low days to cover ratio means shorts can exit their positions in less than half a trading session. This makes a sustained GME-style squeeze based on the liquidity crisis very, very difficult. The exit door is wide open. For investors looking at this, it's important to know where to find this data. You can look up short interest on platforms like Fintel or the official NASDAQ site. A high percentage is a warning, but you must pair it with the days to cover figure. A spike in the borrow rate, the fee shorts pay to borrow shares, is another signal. For ASST, that rate is elevated at 5.84%, but it's not the 50 or 100+ rate you'd see in a true squeeze panic. What's your take on that 18.4% short float? Is this a smart bet against the company's debt, or is it a powder keg waiting to ignite? This tension is also reflected in institutional and insider activity. This isn't just a retail-driven stock. Institutions are deeply involved. NASDAQ filings show 39 institutional holders. While some like Vanguard recently trimmed their positions, other major funds like Millennium Management and MCAP International hold significant stakes, and firms like Alpine Associates just initiated brand new positions. They're playing this volatile name from both sides. Even more telling is the insider activity. In early October, filings showed significant selling of the ASST common stock by executives, including the CEO and CFO. This is typically a bearish sign. However, at the same time, Vivek Ramaswamy, a 10% owner and founder, made a $1.25 million purchase. But he didn't buy the common stock. He bought the new SETA preferred stock. This is a nuanced signal. It suggests insiders may be wary of the common stock's volatility, but are confident in the company's ability to, at a minimum, pay the 12% dividend. Looking forward, the entire future of ASST rests on this delicate balancing act. The expectation is that Bitcoin's price will rise, making this leveraged bet a brilliant success. The reality is that the company is in a race against its own balance sheet. The primary risk is that Bitcoin trades sideways or drops below their $103,115 cost basis. In this scenario, the $19.2 million annual dividend payment for the SETA stock becomes a crushing weight. The company's core asset management business, with its $2 billion in AUM, must perform exceptionally well just to help cover this cost. If it can't, the company faces a terrible choice: dilute the ASST common stock to pay the preferred shareholders, or sell its Bitcoin holdings to make the payment. Both outcomes would be disastrous for the common stock price. The primary upside catalyst is, of course, a significant move up in Bitcoin. If Bitcoin rallies to, say, $150,000, the company's 7,525 Bitcoin become immensely profitable. The 12% dividend becomes trivial to pay, and the common stock, ASST, would likely experience the massive leverage bulls are hoping for. The strategy would be vindicated. This is the tightrope. What investors need to watch next is not just the ASST stock chart. You need to watch the price of Bitcoin relative to their $103,115 cost basis. You need to watch the company's next earnings report to see if the asset management business is generating positive cash flow. And you need to watch the 13F filings at the end of this quarter to see if institutions like Millennium and Alpine added to their positions after this $160 million debt was taken on, or if they are quietly heading for the exits. Comment below with your thoughts on this complex structure. Is Strive's Bitcoin Treasury plus preferred stock model a brilliant piece of financial engineering, or is it a house of cards? In the end, Strive Inc. is a fascinating case study. The market's expectation is that of a simple, cheap crypto gamble. The reality is that it's one of the most complex and leveraged corporate structures on the market today. It is a direct, high-stakes bet on the future of digital assets, funded by traditional high-yield debt. The 18.4% short interest signals extreme doubt, while the oversubscribed $160 million offering proves there is immense institutional appetite for this new hybrid model. The 1.17 price tag on the common stock is just the very tip of a very large and very volatile iceberg.